Hi, lecture number 5, and this is the final lecture regarding books of prime entry, which is the journal or general journal. What is a journal? There could be several reasons where journal is required. Normally, when those categories of transaction which do not fit in any of the previous books of prime entry, they are recorded in the journal. We can have a look at a few examples. Let's go through some of the transactions which do not fit in any of the previous books of prime entry. Purchase and sale of fixed assets on credit. Our purchase daybook and sales daybook are only to record goods on credit. Now here the fixed assets when bought by a company, either a table, chair, shelves, anything, or if they sell their old furniture, they don't deal, their business is not a furniture business. I mean, they don't deal in furniture or any fixed assets. But when they purchase or sale, that cannot be recorded in sales daybook or purchase daybook, because there only we record the goods purchased on credit. So that for that purpose the journal entry will be made and the journal is required. The other reason could be correction of errors in journal ledger. When any error being detected in a past posted entry in journal ledger, it needs to be corrected by making a new entry, and that will be made in the journal. Bad debts written off. To reduce the balances, or rather to write off the balances of those debtors from whom the amount will not be recovered anymore, are put in bad debts expenses in journal. Adjusting entries. At the time of year-end closing, a lot of adjusting entries are prepared, such as depreciation of fixed assets. Depreciation is annually charged on fixed assets to reduce their balances, and that is done through the journal entry in journal. Adjustments of prepayments, such as prepaid rent, prepaid insurance, these entries are made to record expenses of current period from prepayments. Let's have a look at the format of the book. There's a date column, then the particulars and ledger folio, debit and credit. We'll make a few transactions in the journal and we'll post it in journal ledger as well. Machinery bought from CCC Limited on credit for $1,500 on April 5, 2021. We can see here that asset machinery is increased, so it will be debited, and a liability because we bought from CCC Limited. So payable to CCC Limited is a liability. So the entry will be machinery account debit 1,500 and CCC Limited credit by 1,500. In general, a short narration of each entry is given underneath. It's like this. That's for reference, like being purchase of machinery from CCC Limited, wide invoice number, or whatever the reference could be. So this is called the narration of a journal entry. Now, a posting to journal ledger. Debit machinery cross-reference from CCC Limited, and in CCC Limited account that against machinery. The liabilities increase, so the CCC Limited is credited. Now we come to the another example where office furniture sold to FFF Co. on credit for $2,500. The old office furniture, that means it's not goods for the company. The company does not deal in furniture. So that will be made again in journal as a journal entry, and we can see that we have sold our furniture. So a debtor, that's other debtors apart from goods. So the debtor FFF Co. debited, because increase in asset debtor is debited by 2,500, and decrease in asset, which is a furniture, the furniture account being credited, and again the narration being sale of furniture to FFF, and again the reference sales order or whatever the reference could be. Now we come to the posting side. The debtor FFF Co. is debited with a cross-reference of furniture, and furniture has gone, so it's been credited with a reference FFF Co. A third example, a debit of $900 owing to us from KKK Limited is written off as bad debts. A debtor will not pay this amount, so company has decided to write it off. When we write off any balance of debtor, we create an expense called bad debts expense. So we debit the expense as increase in expense by 900, and the debtor's account is credited because we reduce the debtor's account. So asset, again here the asset is decreased, so KKK Limited is credited. Now in narration we will write being written off the balance of KKK Limited as unrecoverable by management approval number so and so. Of course the accountant will never put any debtor's account into bad debts until and unless there's an approval by the management. That's the system of all the companies. Now the posting into ledger account. Bad debts expense increase, so it's debited with a reference of KKK Limited, and the KKK Limited credit. Thank you, and see you in another video.